The Reserve Bank of Australia has lifted interest rates to a 9-year high after the October meeting. In today's video, we're going to take you through what's happened, the likely impact it's going to have on mortgage holders across Australia, and what you can do to help yourself. So Nathan, starts from the top. What has happened here with the Reserve Bank?
Now, the Reserve Bank has made a surprise decision to increase the cash rate by 25 basis points. That puts the official cash rate at 2.6%. Now, the board reaffirmed their commitment to returning inflation to that target bandwidth of 2 to 3%. At the moment, inflation is currently at 6.1%. It's widely expected that inflation will peak at 7.75% later this year. And in today's announcement, the Reserve Bank advised that increasing the cash rate will help them achieve this goal. And there is a prospect for further increases that are likely to be required in the period ahead. So the Reserve Bank hidden nothing really in that. They're saying that the cash rate is going to be increased again. They said they've done 0.25% or 25 basis points this month to give them a chance to see how the economy is going to cope with all these rate rises. We've seen 6 in the last 6 months, and they want to assess the outlook for not only inflation, but the Australian economy and how it's growing moving forward. They've also mentioned that,
Nathan, the impact that's had on the Australian dollar, and even a lot of, it was widely tipped that it's going to be 0.5%. It's brought the cash rate to 2.5%. Even to the average borrower owing $500,000, it's an extra $74 a month. That's sort of going to increase interest rates. And I guess the thing they were wanting to see is there've been a couple of changes lately, like we had the fuel tax excise sort of put back into place in the last couple of weeks. They're wanting to see come up to Christmas trade, sort of what's going to happen. I guess they didn't want to go too hard too soon, right?
That's right. And the Reserve Bank acknowledge that most countries around the world are battling inflation like Australia and finding that they're in a position where inflation is too high. And there's been many global factors. We've seen strong domestic demand relative to the ability of the economy to meet the demand, which is playing a huge role in that. And as inflationary data comes through every 3 months, the Reserve Bank will keep a keen eye on this. And they've mentioned that they will literally do whatever it takes to get inflation back under that target band of 2 to 3%. Now, the central bank's forecast is for CPI inflation to hit around 7.75% by the end of 2022. They said, or predicting, that it's going to hit 4% over the 2023 period, and then it coming back down in the target range not until 2024. So we can see the Reserve Bank widely expected to increase the cash rate by 0.5%. They've only gone for 25 basis points, which is in line with some of the bank's expectations. We'll go through how high interest rates are going to go in a minute, but the Australian economy is continuing to grow solidly, and national incomes are at an all-time high. We've seen record unemployment at its lowest we've seen in the last 50 years. That's at 3.5% in August. And certainly the Reserve Bank of Australia is keeping a keen eye on how things move forward. Jayden, how high are interest rates going to go? We saw recently Commonwealth Bank coming out saying that they see the cash rate might peak at 2.85%, so potentially another 0.25% increase. Westpac saying it could get as high as 3.6%. What do you think? Where do you see rates going from here? And what do you really have to say to our borrowers out there that might be getting concerned about all these rate rises?
Yeah, by moving, I guess, to lower increments, you could be seeing that the Reserve Banks, they're sort of starting to signal a little bit that the the peak of the rate hike is potentially near, obviously nearer to than we were, a couple of months ago. Potentially they're saying there could be another 2 hikes this year in November and December of the same amount. Some of the banks are saying, but yeah, definitely it seems like we're probably coming to the end of the rate hiking cycle, hopefully in the next few months. As for the peak, Nathan, I know you've got some of the banks forecast there. There's a bit of a range. We've even seen some volatility. I know you did a video last week on sort of the fixed rates, and there's some that was sort of coming back. There's some that are going up. So what are you sort of seeing as the forecast, and what are they saying, I guess, for the next 12 to 18 months?
Definitely. Well, if we look at CommBank's forecast, they're predicting that the cash rate is going to peak in November. So they predicted this rate hike of 25 basis points in October. They're saying there's going to be another 25 basis points hike in November, where they say it's going to peak and that's where it's going to stay. And then 2 rate cuts coming in August and November of 2023 of 25 basis points. CommBank being the most conservative out of the big 4 banks. Westpac, they're quite aggressive. They're saying that the cash rate needs to get to 3.6%. That'll happen by February 2023, with 4 rate cuts happening in 2024. They actually predicted a 0.5% increase in October. Obviously wrong about that. NAB, they predicted a 0.5% increase in October. Wrong about that as well. They're seeing that the peak in the cash rate will be at 3.1% in November, which is next meeting. And ANZ, they predicted a 0.5% increase for this month in October, and didn't really happen. They're saying that it'll peak at 3.35% in December this year, with 2 rate cuts in 2024. Now, looking at the Reserve Bank's statement that they released, the media statement, they said, and the key here was, the board remains resolute in its determination to return inflation to the target range and will do whatever necessary to achieve that. So they're not even looking at the house prices or anything like that. They're just looking at inflation. They're locked on, very tunnel vision in terms of what they're looking at and the data that they're receiving. And it seems a bit silly that they're only getting that data every 3 months. If it's such a big, really important thing to them, you'd think that they'd be getting this data more accurately and more often. Jed, what do you say to mortgage holders out there? We've seen 6 rate rises in as many months. What can borrowers do if they've got a mortgage and they want to review it and get themselves in a position where they can feel a bit more confident?
Yeah, there's a couple of things you can do. Some of our clients are looking at short-term fixed rates, like maybe 1 year, just to sort of have some stability there. If it makes sense, there's some banks where the differential still can kind of make sense. There's others where the fixed rates, you kind of might have missed the mark there. I think the second thing is, there's a lot of the banks are sort of giving better deals to new customers, unfortunately. So it's worth potentially reviewing your current mortgage and your current setup. If you have had a loan, even for more than 18 months, I'd say that, there's probably better deals out there. You can definitely, we do that all the time, help people renegotiate. There's even some cashbacks to help with that. You can do stuff like, if you've got an investment property, look at changing the structure. You could look at going interest only to help with some of that cash flow and managing that. It's something that we did, a number of years ago, and it's probably coming back a little bit. Some of the banks will look at sort of potentially changing loan terms if it makes sense for you financially, and if it's within your sort of financial plan, to help with some reprieve there. But yeah, I think overall, you just don't want to sit on your hands, and don't just, I guess, stress about it, thinking rate's going to go up and up and up, and I can't be able to afford it. Now's the time to jump onto it. We've got still getting really good valuations. Asset values are still holding up across the country. So it's especially the case with, like, say you might have bought a home 3 years ago, you had a 10% deposit at the time, and the bank gave you certain rates at that point. Your home might have gone up in value, or your loan could have come down, and you might have a 50% LVR, or, you might have much more equity in the home, and the bank's going to give you much, much better deals. So it really does pay to check out. Hit us up at huntergalloway.com.au. We'd really love to help out. Nathan, do you have any other parting words? Is there any other thoughts on sort of the forecast moving forward?
Definitely. Look, I think it could be short-term pain from what we've seen with a lot of the bank predictions. They're saying that the rates are going to peak maybe later this year, early next year, but they're also looking likely to come back down. So I think, do keep in mind, if you are thinking of fixing in for long periods of time, if that does come to fruition, you could be locking in potentially at a higher state where rates might slide back. Once again, it is really difficult to know. You're only going to know in hindsight. Speak to a professional like ourselves here at Hunter Galloway. We're mortgage brokers based in Australia, deal with people Australia-wide, and we can take into account your personal circumstances to see whether or not it makes sense to fix, how long to fix for, or whether to go variable or renegotiate and get a better deal. Guys, thanks for watching. We'll see you again soon.